Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about VS Media Holdings Limited, ticker VSME.
And VSME it's a really painful, but I have to say academically fascinating case study. We're looking at a microcap in the digital creator space that has just seen a near complete annihilation of shareholder value.
Exactly. It's just chronic price erosion, extreme volatility. Right now, in late 2025, the stock's trading around, 10 cents? Which is just a devastating collapse since its 1-for-7 reverse stock split back in June of 2024.
And that relentless gravity, that's really the core of our disagreement today, isn't it? The central question is this persistent decline in VSME's price governed mainly by the, let's call it, aggressive capital engineering, the warrants, the dilution, the dark pool activity? Or is it just the unavoidable outcome of a business with fundamental operational and solvency failures?
Right. And my position is that while the business is, it's deeply flawed, no question, the speed and the depth of this price collapse are primarily driven by the mechanism of the stock issuance itself. The structure is actively mathematically suppressing the price.
And I'll be arguing the opposite, that the financial engineering is just a symptom. It's a necessary evil that comes from a fundamentally broken business model. The market is simply pricing in the reality of a dying company.
Okay. So my core thesis is that the price erosion we're seeing, it isn't just a simple reaction to a bad quarterly report. The stock is structurally and mathematically suppressed because it's caught in what I'd call a dilution liquidity trap. The constant expansion of shares just prevents any kind of normal supply-demand equilibrium from forming. To really get this, you have to look at the financing offerings from mid-2025. They were crucial, yes. They raised about $9.2 million. But how they did it is the key. They used these things called pre-funded warrants. Now, they're complex and they are immediately toxic for a stock. They often have a ridiculously low exercise price, sometimes as low as 1/10 cent per share.
Right.
And the significance of that is twofold. First, it lets these high-volume institutional traders, think convertible arbitrage funds, hold huge blocks of shares, or at least the right to acquire them, without ever triggering the beneficial ownership disclosure limits. So it creates this massive shadow float. Think of it like an iceberg of shares hidden just below the surface, ready to be sold into the market at any moment. And then second, you just look at the action from November 2025. The expansion of the equity incentive plan added another 5.45 million shares. That's a direct, massive, dilutive event. And the market priced it in immediately, which is why we saw that weakness all through December. It's a mechanism of constant issuance and immediate liquidation that just crushes the stock.
I come at it from the perspective that even the most toxic financial engineering is at its heart a survival strategy, not an independent cause of death. The capital engineering is a symptom, a blinking red light for a solvency crisis that was already there long before this dilution cycle really kicked into high gear. We have to start with the structural unprofitability of the core business.
Okay.
The financial data is frankly catastrophic. For the 2024 reporting period, the company had just $8.25 million in total revenue. That's anemic growth, 3.22% year over year. That's basically zero growth in one of the fastest moving sectors out there, the creator economy. But worse, much worse, is the net profit margin. It stands at a crippling negative 112.2%. Let's be really clear about what that means. A negative 112% margin means for every single dollar of revenue the company brings in, it incurs over $2.12 in costs. The result is a deepening net loss, $7.29 million. This creates a non-negotiable structural solvency gap. They have negative free cash flow, about $2.6 million, and their cash balance is just shrinking. So of course they have to run the stock printing press constantly just to pay the bills. The reverse stock split in June 2024 wasn't some aggressive financial move. It was a desperate act of survival mandated by NASDAQ listing rule 5550A2 just to avoid being delisted entirely. That's the ultimate proof the fundamental weakness was already overwhelming.
I concede that the margin figure is catastrophic, I do. But I'd argue this level of price destruction is simply too fast to be explained by operating losses alone. I mean, how long would it take a normal business to lose that much versus the, 18 months it took this stock to drop from a post-split equivalent of over $5 down to 10 cents? That's because of engineered dilution. The speed and the method of this decline are driven by microstructure activity that actively suppresses price discovery. So how do you explain the persistent off-exchange short volume ratio? It's been hovering aggressively between 17 and 20%. For a nano-cap stock with almost no institutional interest, that's an enormous percentage of daily volume being executed away from the public exchange. This is happening in dark pools by these sophisticated arbitrageurs specifically to build large bearish positions and hide their intent. It prevents a real price floor from ever forming on the lit markets like NASDAQ.
That's an interesting point, though. I would frame the causality completely differently. Dark pool shorting exists and thrives precisely because the company creates infinite supply through those toxic warrants. You identified the informed traders correctly. They're informed because they know the terms of the private financing deal. And they can use that guaranteed future supply of stock to short the hell out of it today.
Okay, but the crucial distinction is how easily they can cover those positions. Look at the short interest ratio. It's just 0.08 days to cover. To put it simply, that means the market's selling volume is so massive and the new supply from dilution is so readily available that institutions can close their short bets almost instantly, sometimes in less than an hour of trading. The existence of this massive resolution-providing liquidity, these new shares from the warrants, is what allows this aggressive shorting to persist without ever triggering a short squeeze or a fails-to-deliver situation. The liquidity that VSME engineered to stay solvent is the very tool being used to suppress its price.
I'm just not convinced that analysis captures the full horror of the operational picture. The regulatory timeline proves the underlying weakness. That June 2024 reverse split was a desperate regulatory maneuver, not a financial power play. We see this post-split drift in historical data for basically all failed microcaps. The split just resets the ledger for short sellers. It makes the stock mathematically more attractive to short at $1.05 post-split than it is to short a 15-cent stock with high friction costs. The core problem is the enterprise value didn't change at all. Only the share count was manipulated.
That's a compelling argument on the history, but have you considered the forward implication of the financial structure, specifically the price protection or what are called ratchet clauses that are so common in these toxic financing deals? This is where the causality really shifts from operational failure to active financial maneuvering.
Go on.
A ratchet clause means that if the company issues new stock below a certain price, let's say 15 cents, the warrant holder's exercise price automatically resets to that new, lower price. This threat incentivizes the warrant holders, the same arbitrageurs, to actively short the stock ahead of new financings. They know the company needs cash again to avoid going under, and if a new offering comes in lower, their warrant price resets lower, guaranteeing them massive, immediate profits. This is pure financial causality driving the price down, completely independent of the operating metrics. It creates the destructive, split-dilute-repeat pattern that just annihilates retail holders. The expectation itself becomes a self-fulfilling prophecy.
That anticipation is certainly devastating. But even that is rooted in the certainty that the company will fail to self-finance. The anticipation of another reverse split, given the stock's current 10-cent price, just drives rational tax loss selling near the end of the year. This whole cycle just confirms my view. The market is acting rationally against a company that has proven it cannot survive without constantly cannibalizing its own equity.
And on top of that, we have to talk about the sentiment dynamic, or really, the lack thereof. The stock is operating in a complete sentiment vacuum. It doesn't meet the $500 million market cap threshold for discussion on major retail hubs. This total absence of, sometimes irrational retail buying pressure leaves the stock entirely vulnerable to the cold calculus of institutional liquidation. There's just no one left to fight the short interest.
Yeah, but I come at that from a different way. The sentiment failure is a consequence of the fundamentals, not an independent cause. The the sentiment on platforms that do cater to microcaps, like StockTwit, it's overwhelmingly bearish or strong sell. Why? Because of what we call bag holder fatigue. This is a rational psychological response to seeing a net loss of 7.29 million and this unrelenting cycle of dilution when your existing retail base is exhausted, cynical, and staring at a 99% loss. Any tiny rally is met with immediate selling from trapped longs just trying to get out with a slightly smaller loss. The overwhelming negative financial reality ensures there's no positive social alpha to counter the selling pressure. The lack of retail support just confirms that sophisticated parties will continue to press their advantage because there's just no risk of a sudden short squeeze.
So we've laid out two powerfully competing frameworks today. I still maintain that the dominant force here is the aggressive capital engineering. It's dictated by the toxic warrants, the promise of ratchets, and it's amplified by that concealed dark pool supply that actively keeps the price pinned down.
And I conclude that this structure is merely a mechanism of death, not the ultimate cause. The price trajectory is the unavoidable reflection of a structural operational failure, characterized by those devastating negative margins and the constant need for cash, which forces the company into these very agreements that guarantee shareholder value destruction.
The complexity here is it's immense, and both forces are clearly and inextricably intertwined. The deep-seated fundamental weakness requires constant capital infusion just for the company to survive.
And the method chosen for that infusion, these toxic structures, guarantees that shareholder value gets annihilated, amplified by all this sophisticated microstructure activity we've been talking about.
The VSME case really does illustrate perfectly how market structure, fundamental reality, and predatory capital engineering can converge in the microcap space to create this almost impossible environment for price recovery. There is clearly so much more to unpack here.
Thank you very much for hearing us. Let us know in the comments what is your opinion. And if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights. And see you in the next video.